Good afternoon and welcome to our webinar this week, the most common questions employers have about self-insurance and why thousands of businesses believe it is the best answer to Obamacare. Thank you for joining us today. My name is Kaya Bromley and I am the president of Your Obamacare Advisors and the author of the Employer's Guide to Obamacare. I've been working on Obamacare for the last couple of years, helping small business owners, franchise restaurant owners, farm labor contractors, everyone deal with this law that we had transition relief for a couple of years, and so people were ignoring it, and now we're down to crunch time. And so we're doing this webinar series to help employers get ready for Obamacare. And as I've mentioned before, this webinar series is brought to you by FreedomCare, and today my guest, it happens to be the president of FreedomCare. Hi, Mark.
Hey, Kaya, how you doing? Thanks for having me.
Good. Yeah, thanks for joining me. So everyone, this is Mark LaPointe, the president of FreedomCare Benefits. Mark has been in the alternative risk industry for about 25 years, so there's no one that I have talked to that knows more about future. The Affordable Care Act changed the way that insurers provide insurance, and it changed the way that employers buy insurance. And self-insurance has been around for a very long time, but not a lot of people looked into it because they thought it was only for very large companies or it was too confusing or scary. And what we're seeing across the board with different commentators, lawyers, and legislators across the country are they're saying that self-insurance is going to become more and more popular as companies realize how costly traditional insurance has become and is going to continue to become. So what we're going to do during this webinar is we're going to talk about self-insurance and go down to the basics and answer the questions that we've been getting about self-insurance. So with that, Mark, I'm going to kind of walk you through these different questions. We've got 5 different points we're going to hit on. And the first one I just want to talk about is the basics of what does it mean to self-insure. And so Mark, like I said, he's been in the business for so long that he knows so much, he gets a little bit technical. So I'm here to simplify the concept because for people who maybe this isn't their, what they've been doing for 25 years. So Mark,
well, Kaya,
yeah,
I'm happy to help, and I will keep the technical lingo down to a minimum.
All right, perfect. So Mark, let's start here. Let's start with the basics. Can you just talk, give us some context about how insurance works in general, and then we'll drop that into the self-insurance context.
Sure. When people buy insurance, what they're really doing is they're shifting the risk. And what I mean by the company. When you do that, just like when you have an accident on your car, the insurance company assumes the responsibility to pay for any claims that would occur under the terms and conditions of the insurance policy.
And so that's the basic concept of insurance. So when
Correct.
We're talking, I know I've got some buzzwords here, and we'll go into some of these things in more detail. But when we're talking about self-insuring, can you explain the concept of risk pooling?
Well, let me first explain very briefly. Self-insuring is exactly what it sounds like. What you're doing is you are becoming your own insurance company. So if you think that you have the ability to assume that financial risk, if you have a claim, you can essentially self-insure for that exposure. So now you are your own insurance company. And it works very much like a deductible on your car insurance. When you take a $500 deductible on your car insurance, you're actually self-insuring that portion of the risk, and you're only having the insurance company pay for anything above your deductible.
And so when we're talking about comparing traditional insurance to self-insurance, the way the structure works is in some areas pretty similar. So there is a risk, like Mark said, and there is a certain level of risk that you, the employer, take on, or you shift it over to the traditional insurance company, and they're the ones that take on that risk. And
absolutely.
within that insurance company, there's different concepts. There's something called risk pooling. That's where they have a certain group of people that are in the insurance program, and there's risks among different people. If you're talking about health insurance, different age groups, or if you're talking about different types of insurance, whatever that risk is. But then stop loss is the part of the insurance where you want to explain stop loss, Mark?
Sure. I'll just go down this list, okay? The risk pooling is exactly as you stated. You're basically taking a lot of people, and the more people you have, the more money you collect. And it also means the more your ability to spread that across a large number of people, you've created a pool to do that. It's a way.
By the way, let me interrupt for 1 second, just to put this in context for people, since this is about the ACA. That's the reason why the administration needs to get younger, healthy people into the exchanges, is this risk pooling concept. Just sidebar, but just to give context.
Exactly right. You're exactly right. And I'll try to keep this in the context of the Affordable Care Act. Stop loss, just like it says, there comes a point in time where the loss that you have paid stops. And at that point, it becomes the responsibility of the stop loss insurance company. That company takes it over from you, so your loss is stopped. The administrative cost.
I think of it sometimes as an umbrella. I think of it sometimes as an umbrella. So if someone has, yeah.
Correct. Sometimes it isn't all-encompassing like a lot of those umbrella policies, but you're exactly right. It just ends your financial responsibility, and it's the starting point of the insurance company that has issued that stop-loss insurance policy. The administrative costs are the costs to run the program. Could be anything from actuarial, audit, any kind of administrative expenses associated with issuing the policy and managing that policy, and that financial obligation between you and the insurance company, and in our situation under self-insurance, between you and your own insurance company. There's always administrative costs to run that insurance company. Profits is that you pay a certain amount of money in premium. The insurance company is banking that they're going to collect more premium from you than they're going to pay in losses. You're banking that you're going to, you're not banking, you're buying the insurance because you're hoping that if you do have a significant amount of loss, it's in excess of the premium you paid, that the insurance company will pick up that difference. So you both are kind of exchanging, hopes in order to have this profit occur. If you paid less premium than you paid out in losses, theoretically you have a profit. If the insurance company, vice versa, doesn't pay out as much loss collecting premium, they have a profit.
And obviously insurance companies are in this to make a profit, and they are they're making a lot of profit.
Well, they're in the business. All companies are in business to make money. MetLife doesn't fly a blimp over your head from losses. That all comes from their profits. When you mean types by that bullet, you mean the types of insurance?
Right. So just that there's all different types of insurance, especially we're seeing with the advent of the Affordable Care Act. There's all different types of insurance that insurance companies are coming up with. But the point of this point was just to talk about that it's not a one-size-fits-all. There's a lot of different types of insurance, and the cost drivers that are going to be impacting the cost of insurance are things like, different requirements that the Affordable Care Act has placed on insurance companies, like the minimum, the cost sharing and the actuarial values and things like that. So there's different cost drivers that are impacting traditional insurance. And so
Absolutely.
So what we want to talk about here, what we want to focus on is the differences between self-insurance and traditional insurance. Because I know a lot of people that
Sure.
I've dealt with, don't even understand the basics of self-insurance and so are just afraid of it. And so we're going to talk about what some of those differences are. So Mark,
Sure.
I know on the surface, there's what's behind the scenes and then what people see on the surface.
Okay. The main difference between traditional insurance and self-insurance is, as you stated and as the name describes, you now are assuming a certain amount of financial risk. That's what your self-insurance layer is, your assumption of risk. Traditional insurance, by and large, has a deductible, so to a certain degree, you always have an amount of financial risk you assume. It's most commonly called the deductible. But when you self-insure, what you do is you typically take a much higher deductible, and the insurance company attaches at a much higher level. So the difference, what you're trying to accomplish is that what you're trying to do is maximize that point at which you're not what I'm going to call trading dollars with the insurance company. And let me give you an example that will clear up that statement. If you can predict approximately how much you will be spending in claims every year in losses, the insurance company could predict that. And history repeats itself in insurance, so you can relatively easily predict your annual losses within a reasonable percent margin of accuracy. If you can do that and the insurance company can do it, the only difference between you and the insurance company taking that predictable layer of risk is you have to pay the insurance company's overhead to manage that risk, which includes their profit, versus what would it cost you to manage that same layer of risk, which is quite a bit less administrative costs, because you don't own a blimp, I don't think, and the profit is yours. So the difference between the two is who ultimately is going to, make the money on that loss layer. And that's really where we maximize our benefits as a self-insured versus buying in the traditional marketplace. It's very seldom that you're going to know what your losses are on an annual basis. If you haven't been self-insuring, the insurance companies behind the scenes, they're predicting your losses, and every year you renew a policy with them, they get better and better at it. And the better they get at it, the more money they're going to make, because they will adjust the premiums, and it's almost always upwards to account for the losses that you may have incurred historically, to be sure that they have a profit in that. And in addition to that, when you purchase insurance, you're buying insurance not only for your risk, but for everybody else's that insurance company is issuing policies for. So no matter how well you do in managing your risk, you may not have a loss for years, yet you're still going to see your premiums go up, which is really what's going on in the health industry. And what you're doing is you have to pay for the bad risk management or loss prevention that other companies have done, because the insurance company has to factor in their poor underwriting on those other entities. So even if you have done well, you likely won't realize the benefits of all your efforts in minimizing your losses, because the insurance company has to make profit, and they make profit by looking at everybody's loss portfolios, regardless of whether or not you're good or bad. You're going to be lumped into the groups, and that group could be bad.
Yeah, that was really a huge thing. I know that we've talked about that a lot. When you consider the fact that if you have a bad year, you're going to get dinged next year because they're going to collect more to make up for your bad year. But then even if you have a good year, you don't get the money back.
You're right. I mean, you rarely, if ever, get the money back. And, I mean, if you look at it just as the Affordable Care Act is concerned, if you're a healthy individual, you rarely go to the hospital. Your premiums never really go down. If anything, they've gone up historically year after year after year, because what they're really doing is they're saying, well, Mark may be doing very well from a health standpoint, and he has never generated a loss, yet we have to increase his premium because individuals who have not been healthy or who don't have insurance, they have to ultimately pay for that, and they pay for that by charging everybody this increase in premium regardless of your own health.
Yep. And I know we're going to talk a little bit more about tax benefits later in this webinar, and we talk about it a lot next week. But touch real briefly just on the difference between the tax benefits between self-insuring and traditional insuring.
Well, there could be no difference. If you are self-insuring and you create your own insurance company, then you are getting the same tax benefits. Let me just say, insurance companies are one of the most tax-efficient corporations in the United States. The big distinction, and I'm going to use a little bit of a jargon here, so I apologize, but the difference is insurance companies pay for losses on an incurred basis, and I'll explain that in a second, versus a paid basis. So if I'm an individual, I can realize tax benefits only to the extent that I pay dollars in claims. Insurance companies get a deduction for their taxes based on what they think they're going to pay in the future, and today, and in the future. So if I'm an insurance company, I can assure you I'm going to think I'm going to pay a lot of losses. Whether or not that's true is irrelevant. From a tax perspective, that means I can deduct all of the expenses of losses that I think I'm going to pay. And it's actuarially determined, but there's a lot of subjectivity in that. So, and we'll get into that later when we talk about how you can realize some of the tax benefits by self-insuring.
Yeah. So now let's get into some of the questions that, so I advise a lot of clients, and I advise them on whatever it is that they want to, strategy they want to implement. And I teach them about different strategies. And I've sat in some of these meetings with very large clients, with brokers who sell traditional insurance. That's all they do. That's all they want to do. And this was a statement that came from real life. This was a broker telling my client that, if you self-insure, you'll go bankrupt if someone gets sick. And then, Mark, you and I have worked a lot on this and understand, and now we understand kind of where these fears come from. So I use that as the question, but what I really want to talk about is what is the real risk, and why are some people so afraid of self-insuring? Because I know there are times when it goes bad, but I want to talk about the reality of it, and let's talk about
Sure.
the real risk of self-insuring.
Okay. Well, number one, that risk of going bankrupt exists for the insurance companies as well. So if you were going to argue if you self-insure, you can go bankrupt. If you buy a traditional insurance company, the insurance company could easily go bankrupt. And if the insurance company goes bankrupt, well, you're not going to get any losses paid. So that risk exists regardless. The issue really is insurance companies have to protect their bottom line the same way that you would protect your bottom line if you were self-insuring. And we call that the reinsurance marketplace. And what the reinsurance marketplace is, it's insurance for insurance companies. So if you're self-insuring, what you're going to want to do is you're going to want to protect yourself so that you can't go bankrupt. If I'm going to set up my own insurance company, I have a risk appetite. I may have a financial ability to pay way beyond my risk appetite, or I may not. But that risk appetite will, if I don't buy insurance for my insurance company at that level, I won't be able to sleep at night. So what we do is we find out where is your risk appetite, and what we're going to do is we're going to actually have your insurance company buy insurance. So when you self-insure, you don't just go self-insurance without any protection whatsoever. All self-insured programs buy protection, and if we go back to the original slides, you spoke about stop loss. Stop loss is extremely common for self-insured health, because what it does is it caps the losses at that self-insured employer's risk appetite, no matter where that is. And, the lower is that risk appetite, the more expensive the stop loss. The higher the risk appetite, the less expensive the stop loss, but you have more financial risk. Insurance companies do the same thing. So as a self-insured, what's the reality of going bankrupt? Little to none if you put together the program properly and you're comfortable that you have purchased enough insurance for your own insurance company. So there should be little to no probability of going bankrupt if it's done right.
The other question that I've gotten is from people who are not familiar with this at all, saying, well, I don't want to run my own insurance company. I run a pizza franchise. I don't have time to deal with claims and billing and doctors. That's another misconception. Can you talk a little bit about how they're actually run?
Sure. When we talk about your own insurance company, we're really talking about a term called a captive insurance company. And a captive insurance company is an insurance company owned by you to insure you. That's basically what it is. And so when you self-insure, you create your own insurance company. There's an entire industry that, is designed around managing totally the administrative requirements, actuarial requirements, audit requirements, and regulatory requirements around that insurance company. So over the years, I've probably set up hundreds of captive insurance companies. And my rule of thumb was pretty straightforward. I ask an hour of your time every quarter. And annually, maybe we'll have a half-day meeting. Other than that, we'll provide you monthly financial statements if you want them, but your captive manager, your auditor, your actuaries, and the regulatory state that you're in, all of these people, their responsibility is to oversee and manage the insurance company at your direction. So we establish how you want the company to run on onset. From that point forward, it should be very seamless within your organization. You should not have to hire anybody to work with you on it. It's all done through the outside service providers whose responsibility is to assure the financial viability and the regulatory compliance of your insurance company.
And when we are talking about the reality, this is a statistic from Kaiser Family Foundation, and this number I've read somewhere else that this has gone up considerably, but it's estimated that 57% of all health plans in the U.S. are self-funded. So there's so many people who are in self-insured programs, they just don't realize it, and so it's not as uncommon as people think, and it's becoming much more common, now that the traditional insurance market is becoming so expensive. And we've already touched on a lot of...
Yeah.
Oh, go ahead.
Sorry, go ahead. I was just going to say you're exactly right. And, self-insuring for health, employees' health, has been around for decades. So the concept isn't new. It's always been something that the big boys did, the Walmarts
right.
of the world. So what happened when the Affordable Care Act passed, and there was some favorable language in there for self-insuring, the marketplace responded by creating programs like FreedomCare that's designed specifically to allow all the benefits the big boys have had now at a level that the smaller employers can benefit from.
Yes, perfect. And we've already touched on most of this, but I'm just going to touch on it again while we're at this slide. But understanding the real risks is that the employer sets their exposure level. It's not an unlimited exposure. If it is, it's not set up properly. So,
Correct.
So when you're analyzing the risk here, it's the risk of the level that you're setting, and I like the way that you said that, Mark. What lets you sleep at night? But you have to do a cost-benefit analysis compared to there's cost inefficiencies is built into traditional insurance. However, that doesn't mean that traditional insurance isn't for some people. We've talked about this a lot too. Some people have no ability, no appetite for risk, and they don't have the ability to properly, run their books and their finances in a way that they can handle, any type of risk at all, and they just want the predictive monthly bill. And so for those people, that is, we understand that for some people that is the right course of action, right, Mark?
Yeah. May I comment on that? First of all, on the cost-benefit analysis. When we look at self-insuring, we utilize the same tools the insurance industry does. We hire an actuary, and we have the actuary look at, massive amounts of data, typically for your geographic location and, your population. And we come up with premium rates. And what we think that premium rate is that's what we think we're going to pay in losses. And then we tag on the administrative costs. So the cost-benefit analysis, we're going to have an analysis that would mirror very much what you would in the traditional marketplace, and we will be able to know very clearly where we think your losses are and where you stop trading dollars with the insurance company and where you need reinsurance or stop loss. The situation where a company, just doesn't want to self-insure, they don't want a captive, it sounds like They don't need it today because even traditional insurance is cheaper. And if you think about it, it may be cheaper today, but it may not stay that way. My point is that the best time to set up your own insurance company is when you don't need it. Because when you need it, so will everybody else in the country. And you'll never be able to put together the programs with the proper service providers in a way that you can sleep at night when everybody's scrambling to get an insurance company formed. So, you know, I emphasize when you don't need the insurance company is probably when you should have it and set it up and let it wait. Because when the day happens, when you do need it, it's awfully nice to have all of the process of creating an insurance company done. Then you just turn the switch on, and now you can respond to a negative turn from the traditional marketplace on your health insurance in this case.
That is a fantastic point. And going to the next slide, understanding the real benefits. I know you brought up Walmart. One of the things that there's always the technical analysis, but then there's also the common sense analysis. And when I'm looking at even my own finances and my own, life, I'm going to strive to be like someone who is doing what I want to be doing, someone who's rich, someone who is well-read. When I think of businesses, when you look at who's self-insuring, almost probably every very large company self-insures. That's not a coincidence. It's because it makes the most financial sense. And so understanding that that's what they're doing, sometimes that's the common sense analysis I look at. They're doing it for a reason. They're not doing it because they're losing money. And one of the things I know we talk about a lot is this idea of the underwriting profit. In an insurance company, there's a certain amount of money that gets paid in through contribution for claims. And then there's a certain amount of money that's used for claims. And then whatever is left over is considered the underwriting profit. And that's just one of the places, Mark, I'd like you to talk about as far as the financial benefits. But and we've touched on it a little bit, but can you talk a little bit about this underwriting profit concept?
Sure. If you don't mind, I'm just going to make a quick comment on everybody self-insuring. Everybody, one way or another, self-insures. When you buy insurance for your auto insurance, you have a deductible. It's either $250, $500, or $1,000. It's very typical. That's a form of self-insuring. The big difference is, are you going to fund for this self-insured layer in a facility like a captive where you actually own an insurance company and reap some of the benefits I'm going to talk about in a second, or are you just going to put it in your bank account and hope that you don't spend it, so when you do get in an accident, the $500 is there to pay your deductible? That is the difference. But everybody, even as individuals, one way or another, we self-insure. So the question is not whether or not we self-insure. We do. But the question is, do we maximize that deductible? Are we at that point of our deductible where we're no longer trading dollars with the insurance company? And I go back to that again because that is the worst situation to be in. Let me deal with underwriting profit. Underwriting profit is exactly what it is. It's the amount of money left over when everything's said and done. You paid the claims, you paid all your expenses, this is your profit. So when insurance companies call it underwriting profit, the only thing that it doesn't include is investment income. So the insurance companies will come up with an underwriting profit, and then they add investment income to the underwriting profit or loss, and that's how they end up with their bottom line. And it's usually that's their taxable income. So we talk a lot about underwriting profit because that's a critical point. Are you collecting more premium than you're paying out in losses? And insurance companies are in the business of not losing money. So what they're going to do is they're going to charge enough premium to assure that they have an underwriting profit. And the way they do that is they're going to predict your losses at a much higher level than is expected. So the underwriting profit becomes very important, and we're going to talk about it, I think, later on when we talk about the very specific tax strategies insurance companies have. But it's very important to an insurance company what that underwriting profit is. However, because the insurance companies are able to deduct for what they think they're going to pay in losses, not what they actually paid, and you're taxed on your underwriting profit, plus your investment income, the insurance companies take a very high estimated loss payment. we call that the reserves. You actually have it on the next line item. Their reserves are much higher than they should be, only because they want to minimize their underwriting profit so that they minimize the taxes. They defer the taxes out to future years. It actually helps offset the cost of loss. So it kind of goes contrary. The insurance companies know they typically have a much higher underwriting profit than they're showing on their books because they have very high reserves to offset the profit to minimize the tax. I'm going to let you think about that and ask a question if you have one.
And that's, you're making the perfect point, Mark. One of the biggest things to understand if you're on the phone and you're getting a little bit lost in this is that as complicated as this might sound, this is what a company that does captives and self-insurance, this is the analysis that they walk you through. And
this is what FreedomCare does. Yeah, FreedomCare, right. Like other organizations, this is what we do. As I mentioned earlier, I only ask a little bit of your time. We will educate you on what the benefits are, and all of that jargon that I just talked about in terms of it was kind of the tax strategy insurance companies have. The thing to understand out of that is insurance companies have flexibilities that you will never have. So why not look at a program where you have all this flexibility that the insurance companies have, and you can maximize your underwriting profit, however, minimize tax through this, offset of expensing what you think you're going to pay in claims, not what you actually pay in claims. So you have this tax deferral. And you're exactly right. It sounds complicated, but your service providers, FreedomCare, this is what we do. You're not going to be just thrown out there to try to figure this all out. It's already, in actuality, FreedomCare is a turnkey solution, so we've already figured all this out. We simply have to show you the program that we're offering to you, and you get all of this. And
there's a lot of business planning that people do when they're using self-insured solutions also is with regard to if they're looking at expanding, if they're looking at also different kind of asset transfer or estate planning. All of these things can get tied into a self-insured strategy. Would you agree with that, Mark?
I absolutely agree. I mean, like any corporation, when you create a subsidiary, you have to think about the effect that subsidiary is going to have on your organization as a whole. So that business planning doesn't change simply because it's an insurance company. It doesn't change the business planning. The only thing that does truly change is you actually gain a significant amount of tools, whether those tools are risk management tools to just lower the cost of claims altogether, or whether they're tied to estate planning and tax, efficiencies in a corporation. Those are things you didn't have because you didn't own an insurance company. But an insurance company really is a subsidiary in your organization that you have to plan for like any other subsidiary you would create.
Perfect. And I know we spent a lot of time on those first 2 points, but those were the most important to give you context. So now we're going to go through the rest of the points here. And the third one is, will my employees get substandard coverage? One of the things that is surprising about that statistic I gave earlier is that maybe not most, but a very large percentage of Americans are already insured in a program that is self-insured. They just don't realize it because they get a regular card. There's the large insurance companies that will be the face of the self-insured company for you. But you're the one that decides what it looks like behind the scenes. You're the one, through your administrator and your third-party administrator, determine what provider networks you use. You have much more flexibility and control in setting the benefits as opposed to, buying off-the-shelf insurance products that are offered by a large company. Anything else that you would add to those points, Mark?
You're dead on. I mean, you're in the driver's seat. So if your employees are getting substandard coverage, it's because you've made the decision that's what you want to give them. If they're getting, platinum coverage, it's because you've made the decision that's what you want to offer them. So there really is no reason for you to offer anything more or less than what you want to offer your employees, because this is your insurance company.
And you can choose from a variety of different insurance companies to be the name on the card. How does that work?
Yeah, the networks, usually that's the provider network. You partner with a provider network. You can actually create your own, or you can go to a non-provider network program, which we won't get into this discussion. But again, that's your decision. In certain situations, the network may choose not to play in your sandbox, but typically they want business, and if you're going to bring them, lives into the program, you can get almost always with a provider network or a group of doctors that would be satisfactory both for yourself and for your employees. And you'd be surprised, and I hear this a lot, well, we're on this A provider network, and most of my employees like B provider network because, my doctor's on B, and I like my doctor. I'm not moving. You'd be surprised how many doctors are part of multiple provider networks. If one is in Blue Cross Blue Shield, they're going to be in Anthem, or Humana. It really isn't that unusual for a doctor to be part of multiple networks. So the probability of that doctor not being on provider network that your employees like is pretty small.
Mm-hmm. And this brings us to our next slide. How is self-insurance a solution to Obamacare? And this is where now we're into really my area of expertise, which is the ACA. And obviously I've been studying this very in depth since it was passed. And as I touched on at the beginning, there's going to be some issues with traditional insurance in the coming years. I just met with someone this morning who told me that her insurance rates tripled for her company with her traditional insurance company. And of course I said you need to look into different options. One of the reasons for the cost going up is because of these medical loss ratios. That's the part of the law that said a certain percentage has to be paid toward claims and can't be paid toward anything administrative or brokerage commissions or anything like that. So in order to be able to still make their profit, they're increasing rates. Minimum participation, although they're not allowed to decline or to have the minimum participation rules the way that they used to, they're still able to get to the same result. So in the past, they might have told you that you have to have 85% of your eligible people buy insurance in order to get their policy, and they might be dropping those. But next year, if you only had 5% or 10% sign up, that's probably the 5 or 10% that needed it the most. So the way the insurance company is going to make up for that is they're going to now increase the contribution or increase the rate for that 5 or 10% so that they can still make their profit. Because as we've been saying all along, it's not a charity. They're in this to make money. Also, traditional insurance has a lot of state regulations. They're regulated by every single state, and every single state has different regulations. We've all seen that the costs are rising. The ACA regulations are very onerous for the insurance companies. So there's a lot of tough things that traditional insurance companies have to deal with that is going to make it even more difficult in the future. Mark, do you have anything to add?
No, I'll add something that you actually told me way back when we met, probably a couple of years ago now. The reason why self-insurance is so popular is when the ACA was written, it was very clear by all of those who were debating and discussing it, self-insurance works. Mm-hmm. So they specifically, line item that as something they knew by looking at the historical self-insured, the big boys and a number of small boys, and basically said it works. So we're not going to mess with something that works.
Yes. That's a huge point, Mark. Thanks for bringing that up. That in all of the regs and in a lot of the commentary, they never touch self-insurance, which is an interesting thing because it has a lot of favorable treatment, which I'll get into on the next slide. There's a lot of favorable treatment for self-insurance, and they've had every opportunity to strike it down as a strategy, and they're not doing it. In fact, like you said, they're saying that this is a viable strategy. So I just read an article, I think it was Washington Post in the last week, that was saying, some of these strategies that employers need to check their conscience if they're going to use some of these strategies. And the reality is, it's not about checking your conscience. It's about finding the most commercially viable, competitive way to handle this very onerous law. And the fact that everything got, there's so much responsibility and cost got shifted onto employers. Employers are fools if they are not looking at every single option to minimize their costs, because even though some cost containment went onto the insurance companies and the cost of medical care, it wasn't nearly enough when you compare it with the amount of shifts that went to employers. So there's definitely trouble ahead. And when we talk about the advantages of self-insurance, the biggest one is that self-insurance is governed by ERISA. That means that it's not subject to any state regulations. So, I'm close to California, and most of my clients are in California. The state of California tries to regulate insurance all the time, and if you're self-insured, you don't have to worry about those because it's a federal ERISA plan. The essential health benefits, there's no requirement when you compare that. The small group has to have all the essential health benefits. That's why the small group plans have gone up so much in price. The other thing is with the flexible plan design. So there's a lot of, when I referred to a second ago about these commentators saying employers should check their conscience, there's a lot of strategies out there that satisfy the mandate, that satisfy the A penalty and the B penalty, and they're not great cushy coverage like we used to enjoy in the past, but employers can't afford that in a lot of instances. I have one client who went from insuring 50 people last year to insuring 2,000 people next year. He can't afford to have a big cushy plan. So using a self-insured program gives them a lot of flexibility in complying with the mandate. And then also, you don't have to worry about, there's different MOOPs as the maximum out of pocket. There's different rules for self-insured groups with regard to the out-of-pockets. You can require higher deductibles, higher co-pays from your participants than you can if you are a traditional insurance program. And then also, you don't have to worry about minimum participation if you're self-insuring your own plan. So that's a huge variable when we've actually seen it. So we've got a lot of clients who have went ahead and decided to comply over the last couple of years, comply with the ACA, to see what was going to happen so that they could then adjust as they get closer to, the actual employer mandate penalties going into effect. And what we saw in a lot of the cases, if not every case, when the insurance company got rid of those minimum participation rules and said, well, we don't care if only 2 people out of your 500 employees signs up, but then the next year they raised the rate so much that they couldn't even possibly afford it. So these are just some of the advantages from the ACA perspective of self-insuring. Mark, do you have anything to add on that one?
Just a more of a thought. I was listening when you mentioned that somebody said that employers should check their conscience. One of the things that, somewhat bothers me by that, number one, is the thought that because an employer self-insures, it means that he is exclusively preventing his employees from doing anything but what he's doing as a self-insured. They don't, it doesn't, when you self-insure, it never precludes the employees from going out and buying additional coverages that keep them up at night. If it isn't included on the employer's plan, you can always buy it yourself. It doesn't mean just because an employer is self-insuring and offers something that may not be exactly what this employee wants, doesn't mean they can't go out and get something more. So I don't understand check your conscience. An employer has to make what will keep a decision, financial decision, that's going to keep him in business. And if you look at the FreedomCare program, we're giving, of your example, the 50 that went to 2,000, under the FreedomCare program, we'd be giving, over, 1,000, almost all 2,000 employees, something they never had before. Mm-hmm. And now you go from saying, I never had anything, now I have something. And if it isn't, what I really want, because I want a richer health plan, I can still go out and buy it. So if anything, the employers, those at least that are participating in FreedomCare, actually do have a conscience, and they don't have to check it. They're doing something for their employees that they never did before, and they're not preventing them from buying richer plans, and people who historically haven't had it may or may not. So I don't understand that comment. I think employers are making the best decision they can make based on their financial ability to provide health care to their employees.
Yes, you're dead on. And the other point I make about that whole check your conscience argument is that's a legislative, that's a policy issue, because what they're actually arguing in those situations is that employers should be doing more than the law requires just because they should. And that's incongruent. That doesn't make sense. If there's more that should be done with regard to the level of care that is available for people, that's a legislative issue. That's not something employers don't have time, especially getting so close to the end of the year. And it doesn't make sense in their business structure to be thinking in terms of that right now. Many of them are so out of whack with what these penalties are going to cost, and they're being unrealistic about it. We calculated the penalties for a new client that we had last week, and if they had gotten assessed every single penalty under the ACA that could be assessed, their penalty exposure was over $7 million. And that, I'm not exaggerating. We've obviously helped to guarantee that they're not going to incur that, but that's what their penalties would have been. And let's talk a little bit about ACA compliant plans. Now, a lot of this is what FreedomCare offers, but the point of this is that if you're self-insuring, you can do this. You can satisfy both the A and B penalty, and you can offer what are these people are calling them these skinny plans, or they're calling them MEC plans, which are minimum essential coverage. And if you listen to any of my other webinars, we've gone into the specific details of how these plans are structured, and I strongly recommend looking into those. I have clients that are doing these type of skinny MEC plans, even if they're offering other insurance, and even if they're offering it to their variable hour employees, because they don't want to run the risk of someone in their HR department or payroll department counting their employees wrong and finding out after it's too late that they did not offer insurance to everybody that has to be offered insurance, and that penalty gets triggered, that $2,000 penalty gets triggered for everybody, even the ones that were given insurance. So these ACA compliant plans with the with the flexibility of a self-insured program, it's the optimal way that I have seen in all of the different strategies that I've seen out there. And like I said, we've covered this in much depth in the other webinars, so we're not going to talk about it too much, but it is something that FreedomCare is sponsoring this webinar program because this is what they do. They guarantee ACA compliance. And although I don't put it on the slide here, one of the reasons why it's a most favorable for self-insurance is because of the regulatory compliance, because all employers are required to comply with the ACA one way or the other, whether it's paying the penalties or offering the insurance. So when you are self-insuring for ACA compliance, you're not doing some kind of weird esoteric coverage that we'll talk about more next week, but it's something that the law is requiring anyway. And Mark, just so that we can quickly get through this, I'm going to let you talk about this one, the mechanics of self-insuring, because this is what FreedomCare does. So we're almost out of time, so why don't you quickly, we're going to talk about the mechanics and then the costs related to self-insurance.
Sure. The mechanics of self-insuring in the FreedomCare program is very different than what you would have in the more traditional captive insurance programs. What we did is we created our program utilizing some legislation that I was very involved in the state of South Dakota that allows you to create your captive insurance company simply by signing your name on a formation agreement. So most captive applications require a binder and an army of service providers to get that done and approved at the Department of Insurance of whatever state you're in. For FreedomCare, the process is a formation agreement that you should read, and you sign it. And when you sign it, we need your census data, and within typically 30 days, you will have your own insurance company, and it will be insuring your employees for your self-insured health plan under the ACA, under our plan designs, which we won't get into on this slide.
Mm-hmm.
Cost is very, very simple. Again, I could speak about all kinds of different costs on the various domiciles, but for the FreedomCare program, where we charge $1,000, and that's an application fee that goes to the South Dakota Department of Insurance. And then, like any corporation you create, you have to capitalize it. So you have to do an initial capital, which is your money, but it has to go into the insurance company, of $25,000. And that's it. And I'm just going to compare quickly because I did hundreds of captives prior to FreedomCare. Typically, a formation of a captive insurance company could range anywhere from $20,000 on the low side to $150,000 on the high side. And then you have capital almost always somewhere around $250,000. So you can see that we've really brought down FreedomCare so that the small guy now can do what the large guys have done decades.
Yeah, great point. And so since we're out of time, let's go to if anyone has any questions. If you have not already put a strategy in place for your ACA compliance, feel free to contact our organization, your Obamacare advisors. We are an independent organization where we can help with if you're doing self-insurance or whatever the strategy is. We'll help. We stand in the shoes of the employer, and we help you walk through the best strategy for you. And we have a team of lawyers and also other areas of expertise depending on what assistance you need preparing for the ACA. We also help brokers and other experts who are helping employers that need to understand different areas of the ACA. And then if you need to contact FreedomCare Benefits, there's the contact information for FreedomCare Benefits. They are a 100% guaranteed ACA compliant solution. And as Mark said, they've taken all the guesswork out of putting together your own captive, but they've also added to that complete guaranteed ACA compliance, which in and of itself has its own value, even if it weren't for the captive and the self-insurance, which has its own value. So please feel free to contact any of us and join us next week, where we will be talking about how one company saved over $600,000 implementing Obamacare, the 5 things large employers need to know about alternative risk financing. And Mark will be joining me again next week. And thank you, Mark, for your time, and I'll talk to you again next week.
Kaya, it's always a pleasure speaking to you, and I always enjoy seeing just how well you're able to bring very complex subjects down to a level that we all understand. So thanks for doing that.
Thank you so much. All right, everybody, we'll talk to you again next week.